A data-driven approach to managing financial crime risks in banking leverages data analytics, artificial intelligence, and automation to improve detection, prevention, and compliance. It replaces traditional rule-based systems with adaptive, real-time, intelligence-led strategies. What are the key components of financial crime risk management when it comes to AML, anti-money laundering, transaction monitoring? Detecting suspicious transactions using rule-based and AI-driven analysis, as well as sanctions screening, compare customers and transactions against global watch lists. What about customer risk scoring? Assigning risk levels based on transaction patterns, source of funds, and business activities is carried out. And regulatory reporting. This means automatic filing of suspicious activity reports, SARs, and currency transaction reports, CTRs. What about Know Your Customer, KYC? It includes identity verification by using government databases, biometric authentication, and digital ID checks. Furthermore, customer due diligence, verifying business ownership, financial activities, and transaction history, as well as enhanced due diligence, applying stricter checks on high-risk customers, for example, politically exposed persons and cross-border entities. Ongoing monitoring is key for that. Continuously track customer behavior to identify anomalies. Let's continue seamlessly with fraud detection and prevention. Real-time payment monitoring flags unusual transaction behaviors, for example, rapid withdrawals or international transfers that are suspicious. AI-powered risk scoring uses machine learning to detect fraud patterns and prevent unauthorized transactions. And device and behavioral analytics. It uses AI to detect login anomalies, unusual geolocations, and inconsistent spending habits. Multi-factor authentication, MFA, adds an extra layer of security to prevent account takeovers. How do banks manage financial crime risks? Of course, it starts with the data sources. Banks integrate multiple structured and unstructured data sources to monitor financial crime risks. As we heard already earlier in this course, we talk here about core banking systems for transaction data and account history, third-party sanction lists, biometric and identity verification data, for example, fingerprint scans and digital IDs, as well as public and private databases. Here we speak about credit bureaus, tax records, blockchain analytics, and so on and so forth. Afterwards, in the data processing and integration step, as we also heard, ETL pipelines are used to clean and integrate data from multiple sources. Graph databases, for example, Neo4j, map relationships between accounts to detect fraud rings. AI and machine learning models are used to predict fraud patterns in real time. What are these real-time detection mechanisms? Rule-based engines identify predefined suspicious activities. AI-driven fraud analytics use deep learning for anomaly detection, and automated reporting and compliance dashboards are generated for AML reports and audit trails addressed to the regulators. Before we conclude this lecture, what are the challenges and best practices in financial crime data management? High false positives in AML alerts can be addressed by using AI to refine risk models and reduce manual investigations. When we face data silos, as we heard across banking systems, implement a centralized data lake for real-time analytics, an issue that has become quite prevalent in recent times. Evolving fraud techniques, AI-powered scams, and deep fakes continue to grow. Requires continuous update of fraud detection models with new data. And last but not least, compliance with global regulations. Automate AML and KYC reporting with AI-driven regulatory technology, so-called RegTech technologies. To wrap up this lecture, banks manage financial crime risks using AI-powered fraud detection, real-time transaction monitoring, regulatory compliance automation, and advanced data integration.